Welcome to the deep dive. Today, we're getting access to some fascinating internal strategy documents from a high velocity prop tech company called Funflow. And what we're looking at is it's nothing short of audacious. They're planning what they call a strategic land grab in a really fragmented corner of the real estate world.
Right. Specifically, the lower tier market. We're talking residential flippers and, small builders.
Exactly. And the documents we have really assess the core mission here. Can they actually dominate this underserved niche with AI tools?
And this is the key. Can they use that foothold to move upstream and, start challenging the big institutional players, the giants like Juniper Square and InvestNext?
That's the real tension, isn't it? Because they're trying to build something that, well, it starts out looking like a sleek B2B CRM.
The simple tool for deals, yeah.
But it has to become something else entirely. It has to morph into true, legally compliant capital infrastructure software. And that jump, that's a totally different level of trust and compliance. So our mission today is to unpack whether they can actually make that leap.
Let's do it.
Okay, so let's start with the basics. Who exactly is Funflow going after? Who is this flipper niche, and I guess why is nobody else paying attention to them?
So they are laser focused on let's call them the lower and mid-tier real estate operators, the folks flipping houses, doing renovations, small-scale development. But the key insight in these documents is how these operators raise their money. It's not like a big Silicon Valley startup. They aren't issuing complex equity that needs intricate cap tables.
Okay, so no shares, no stock options. What are they using instead?
It's much simpler, much more transactional. It's almost all loans, debt instruments, and promissory notes.
Got it. So an operator needs, say, $300,000 for a flip. They go to their network.
Exactly. They raise it from a few private individuals, promise a fixed return, and the whole thing is done in maybe 6 to 12 months.
And this isn't just a tiny market. The analysis put a number on it.
Not at all. We're talking about an estimated 50,000 operators out there actively raising private money this way. But here's the pain point, and this is why it's so ripe for disruption. They are managing all of this, the commitments, the interest payments, investor updates, using wildly inefficient manual tools.
Let me guess. We're talking about the infamous spreadsheet horror stuff.
Absolutely. We're talking 5 different tabs on a spreadsheet, one for interest calcs, one for contacts, another for payment dates, and then they're manually sending texts and emails for updates. It's a mess.
And the big guys, the Juniper Squares of the world, they just don't care.
They're built for $100 million funds. They can't even, it doesn't make sense for them to service this low end of the market. The price points just don't work for their feature set.
So Funflow sees this void, and they're coming in with a classic SaaS weapon for this so-called land grab.
That's right. It's the freemium model. They give away the core tools for free deal tracking, basic investor management, just to get massive viral adoption among those 50,000 operators.
So once you're hooked?
Once you're relying on their free tool for your next flip, they upsell you. They push you to paid tiers that unlock all the cool AI automations for things like compliance and fundraising outreach.
It's the best kind of sauce, right? You're replacing bad tools that people already hate using.
It is. But, and this is the reality check in the internal analysis, there's a ticking time bomb in this strategy.
Okay, what is it?
It's the lifetime value, the LTV, of that flipper customer. Remember we said their deals are based on debt?
Right, they're transactional.
So think about it. A flipper raises money for a project, takes 6 months, they pay off the loan. And then what? They often cancel their subscription because they don't have another deal lined up right away.
So Funflow only gets that subscription revenue for 6 months. They have to fight to win that customer back for every single deal.
Precisely. And if the real estate market cools off even a little bit, flipping activity just plummets, and Funflow could face, a massive churn problem. That transactional nature means they have to find a better way to lock the user in long term.
Which is the perfect lead-in to this comparison they keep making. The sources talk about Funflow wanting to be the next Carta. Carta started with small startups, and now they basically own private equity infrastructure.
It's a really compelling story, but the analysis flags this as a dangerous blind spot. You just can't be Carta if your foundation is dead.
Why not?
Because Carta's moat is equity. It's law. Carta manages the legal source of truth, the capitalization table that defines who owns what. If you're on Carta, switching platforms is this massive, years-long legal and administrative nightmare.
The switching costs are just enormous.
Phenomenal, yeah. You just don't leave.
Yeah.
But with Funflow, if I'm a flipper and I pay off my loan, I can just walk away. There's no legal anchor.
So they're not really building Carta for flippers. It's more like...
It's closer to building a QuickBooks plus a CRM for private lenders, which is a fine business, but it is not a multi-billion-dollar strategic asset.
Okay, but hold on. I have to push back a little. Even if the deals are transactional, isn't there huge value in just owning the data and the contacts for 50,000 active operators? They own the distribution.
That's a fair point, a really fair point. And that's why distribution is listed as one of their 3 potential compounding moats.
Yeah.
But to get the kind of valuation they want, they have to make a shift.
From what to what?
From being just a management tool, which is a cost center for the user, to becoming a capital faucet, a revenue generator. The platform can't just track the money. It has to actively go out and get it for them.
And the sources identify how they do that, right? The 3 moats?
Yes. First, data gravity learning from investor behavior, which deals get funded, who says yes. Second is workflow depth, covering everything from the legal setup to the final payment. And third, and this is crucial, they have to convert that initial distribution mode, the free product, into a real retention anchor.
Which brings us to their killer feature, the thing that's supposed to solve this LTV problem by locking users into equity. Let's talk about the syndication in a box.
Okay, so this is where the strategy gets, I think, really brilliant. Funflow is planning to offer a completely automated 7-day syndication in a box service, and they're pricing it around $6,500.
And this is for a flipper who wants to level up, right? Move from a simple loan to a bigger multi-investor equity deal.
Exactly. And that price point, that timeline, it's radically disruptive.
Why? What's the status quo look like?
It's a disaster. It's a terrible choice. Option 1, you go to an expensive big law firm, you pay them $15,000, maybe $25,000, and you wait 3 to 4 weeks for all the legal docs.
And what are those docs specifically? I keep seeing the acronym PPM.
Right, so PPMs are private placement memorandums. They're these dense legal documents that detail the whole investment, all the risks, and make sure you're compliant with SEC rules, usually Regulation D.
Legally required.
Mandatory for raising private equity. So that's option 1. Option 2 is you try to DIY it with some templates you found online, which is just, it's a compliance nightmare waiting to happen.
So Funflow comes in and says, what costs $20 K and takes a month, we'll do for $6,500 in a week. That's huge. So why haven't the big guys like InvestNext already done this?
It's what the document's called the legal mode of fear.
The mode of fear?
Yeah. Competitors like Juniper Square, they're software companies. They are terrified of being accused of the unauthorized practice of law, or UPL. They'll give you the software to manage the deal, but they will not touch the actual legal drafting of the PPMs. Too much risk.
Okay, so what's Funflow's secret? How do they unlock this?
Their plan is to use SEC-reviewed, templated documents. They automate the whole process of plugging in the deal specifics. So by offering this automated templatized service for $6,500, they're essentially commoditizing a high-margin legal service.
It's an order of magnitude improvement.
In both speed and price, yeah.
So this syndication in a box thing, it's not just another product. It's really a strategic Trojan horse for the whole business model.
It's everything. It's designed to be a CAC killer, a way to slash their customer acquisition cost, and it's their ultimate retention anchor. By offering this, Funflow captures the customer at day 0.
The moment they decide to form a legal entity.
Right, and once that entity is legally born on Funflow's platform, the operator is basically locked in for the entire multi-year life of that equity deal. And that solves the churn problem, the LTV problem we talked about.
And this is a big market to disrupt.
The numbers are really compelling. You see about 40,000 Regulation D filings every year. That's the legal path for these deals. If you multiply that by the traditional legal fee, you're looking at a $600 million annual legal spend that is just sitting there, ripe for disruption.
Wow.
That's the prize for this one feature.
Okay, let's pivot to the AI side of this, the agentic model.
Yeah.
Because they talk about moving from just automation to full agency. What is the real difference between those two things?
Yeah, this is the difference between a useful tool and like a business partner. What they have mostly now is automation.
Yeah.
That's simple if-then logic. You know, if an investor clicks a link, send them this pre-written template. Right now, Funflow is basically a HubSpot for flippers.
Right.
What they're promising is agency, and that requires autonomous decision-making. It requires synthesis.
Give me an example. What does that actually look like?
Okay, imagine this. Instead of you sending one standard template to 100 investors, the AI does what they call contextual drafting. It reads your deal memo, it cross-references that with each investor's profile, what they like, what they funded before, and then it writes a unique, personalized email for every single person. It decides the tone, the selling points, all by itself.
So it's the difference between a system that helps me do my tasks and a system that does the task for me unless I tell it to stop.
That's it. That's the emotional relief that operators are desperate for.
But to move up market, to get from the flipper niche to serious funds, they need more than just smart marketing tools.
And you've just hit on what the analysis calls the trust gap. They have to stop building just flashy marketing features and start building boring but mandatory fintech infrastructure.
What are those non-negotiable fintech features?
3 things jump out immediately. First, complex waterfall calculations.
Okay, for the listener, what does waterfall mean here?
A waterfall is just the complex math for figuring out who gets paid what and when in an equity deal. Investors get the first 10% of profits, then the operator gets the next 5%, then they split the rest 60-40. The software has to do that perfectly every time.
Okay, what's second?
Second, automated K-1 generation for tax documents.
The dreaded K-1.
Every single investor needs one for their taxes. And third, they need secure ACH and banking integrations. You're not just tracking payments anymore. You're moving millions of dollars. You have to look and act like a bank.
And what about the security backbone for all of this? I saw SOC 2 Type 2 certification mentioned.
That was absolutely critical. You cannot touch institutional money without it. SOC 2 Type 2 is this exhaustive third-party audit of your security, your compliance, your controls. It's the stamp that tells big investors, we can be trusted with your sensitive financial data. Without it, you can't even get in the door with a serious fund, period.
So if they do all this, they win the land grab, they launch the syndication wedge to get equity users, and they build out these fintech features to close the trust gap. How far are they from actually being the top product?
The sources are pretty clear on the timeline. For their initial flipper niche, those 50,000 operators, they're maybe 3 to 6 months away from total dominance. That's if they execute on the agentic model and ship that syndication box right now.
It's theirs to lose.
It is. But challenging the big established players in the broader fund market, that's a different story. That's going to take more like 12 to 18 months minimum.
And why the longer timeline?
Because they just have to build years of feature depths in fund administration. Things like those super precise waterfall calculations. They have to match the institutional trust that the incumbents have spent years building.
Okay, so that's the roadmap. But if you had to stress test it, which one of those big pieces, the AI, the syndication wedge, or the fund admin features, which one brings the whole strategy down if it fails in the next 6 months?
That's the key question. And the consensus in the documents is that if they fail to ship the syndication in a box, the whole thing collapses.
Really? That one feature?
That one feature. Without it, they can't solve the LTV and debt problem. They just stay a high-churn CRM for flippers, which is not a scalable business. It's the engine that converts free users into long-term, high-value customers. It enables everything else.
Okay, so let's wrap this deep dive up. What are the clear, actionable priorities?
It really boils down to 3 things. First, they have to finish the agentic loop. They got to prove the AI can own the capital raising outcome, not just be a better tool. They need to be obsessed with zero-effort capital raising.
32.
Ship the syndication in a box. That is the conversion engine. It's what turns free distribution into real recurring revenue and solves the churn problem.
And last.
And third, they have to start laying the groundwork for fund admin immediately. Build out the waterfall calcs, the banking integrations. That's how they create those massive switching costs and, eventually move upstream.
It's a huge undertaking, but it sets the stage for a really dramatic disruption. So here's the final provocative thought for you to think about based on all this. The real measure of FundFlow's success, it won't be about how many features they ship. It'll be about whether they can achieve what the sources call emotional relief for the operator. If that system can genuinely tell a flipper, I will raise capital for you unless you stop me, then they will own the entire private real estate capital infrastructure layer. That shift from simple automation to truly autonomous agency, that's the dynamic to watch.